Good morning. Thank you for joining us. My name is David Hirschman. I'm President and CEO of the U.S. Chamber's Center for Capital Markets Competitiveness. Delighted to have you today for our event on how business is using data and artificial intelligence to enable financial inclusion. 2 years ago, we built on what we were already doing in diversity and inclusion by launching an expanded equality of opportunity initiative under the leadership of Rick Wade and Suzanne Clark. The goal was to drive real sustainable solutions that will help close the race-based opportunity gaps in 6 areas: education, employment, entrepreneurship, criminal justice, health, and wealth. At the Center for Capital Markets, as part of an all-of-a-chamber approach, we've taken on the role of finding ways to expand access to economic opportunity through access to credit. In that vein, last spring, we released some new data in a study that we entitled The Economic Benefits of Risk-Based Pricing for Historically Underserved Consumers in the United States. We sought to show empirically with data two things that we believe were true. First is that risk-based pricing enables better outcomes for consumers up and down the economic ladder, so in every segment of the financial spectrum. And second, that the risk-based pricing system helps consumers move up that ladder and creates opportunity for them to have more access more affordably as they improve their risk profile. We also knew that we needed to focus on how to build on this system, to build on what works in risk-based pricing, to expand opportunity, particularly for minorities and underserved communities. Today's event is part of that sustained effort to measure how far we're coming and to help spur further progress. In just a moment, I'll have a fireside virtual chat with Chris Cartwright, the CEO and president of TransUnion, who will join me to discuss how his company is addressing financial inclusion. After this conversation, I'll turn it over to Bill Holtz, vice president of the Center for Capital Markets, who will have a panel with Discover, US Bank, and Rocket on how each of those companies are using data and AI to reach more consumers and meet their needs. I'm very pleased to start the program by introducing Chris Cartwright. Chris has served as president and CEO of TransUnion and a member of the TransUnion board since May of 2019. He joined the company in 2013 as executive vice president, U.S. Information Services, which is TransUnion's largest business unit. He helped lead TransUnion's transformation into a global information and insights company, including providing consumer reports, risk scores, analytical services, decision technology to a range of customers from financial services, insurance, tenant, employment screening, and the public sector. Chris, thank you for joining us this morning.
Good morning, David. Great to be here.
So in watching your Investor Day presentation last night, I was quickly reminded how core finding ways to bring more consumers into the system is to TransUnion's business. And so I thought, our data showed, our study that I mentioned showed that risk-based pricing is particularly helpful for minority and low-income households. But you have a perspective to look at it, not just from the United States, but globally. Can some have argued that maybe risk-based pricing does not work as well as if we had one price for all. Can you give us your perspective on what that would mean for consumers?
Yeah, well, the U.S. economy, the consumer-driven U.S. economy, is the envy of many countries and markets around the world, and oftentimes what we're bringing across our global portfolio of over 30 different country positions are the practices that have been implemented and proven over time here in the U.S. And risk-based pricing based on comprehensive and accurate information about a consumer's ability to repay debt obligations is a big part of that. And in short, look, it allows lending institutions to tailor the terms that an individual consumer receives based on their prior performance in satisfying loan obligations. And in doing so, it promotes efficiency in the markets, and it promotes the safety and soundness of our lending institutions. I mean, typically what you see in markets is that improved access to accurate and comprehensive information results in greater efficiencies, and that's a principle that certainly, underpins the U.S. Um, financial markets, and the same is true in consumer lending. In the absence of information, lenders have to assume the worst, and they have to apply a risk premium across all of the transaction types to really mitigate and to protect their institutions from unknowns, from uncertainty. So we're a big believer that full and fair and objective information is an inherent good in terms of efficient markets, but also enabling consumers to access the credit that they need to get the things that they want to improve their lives.
So I know what part of what TransUnion does is advocate for creating systems that would bring in consumers around the world. What about the U.S. financial regulatory structure has enabled the progress we've made to date? And are there things that concern you about policies that might make it harder for you to bring new data into the system and bring more consumers into the system?
Yeah, well, look, we have a well-functioning system here in the U.S., but it is there's still opportunity to improve that system. One of the innovations that TransUnion pioneered about 8 years ago was the movement from calculating a credit score based on a point in time to actually looking back almost 3 years and calculating a score for each month over that period. And in doing so, being able to show the trajectory of consumer financial management performance, if you will, debt repayment performance. And this movement to trended data allowed us to access more information about consumers and therefore score tens of millions more consumers here in the U.S. So that innovation to trended data helped institutions in to service and to include more American adults. On top of that, we've been pioneering the use of alternative types of information where we can gain access to it to again enable the inclusion of more Americans, oftentimes disadvantaged populations that haven't had access to credit, or younger consumers that are still climbing up the economic ladder and looking to establish themselves. And I think principal among that would be these data types would be rent payments. Oftentimes for younger consumers or just non-home owners, their monthly rent is the largest bill that they pay, and they pay it consistently. And if we could gain access to that information at scale, we could score millions, if not tens of millions, of more Americans and enable them to access mainstream consumer credit. On top of that, the monthly utility bills that so many consumers pay regularly and promptly is another important signal as to a consumer's ability to service debt in order to borrow, all different types of borrowing, even wireless bills or the monthly charges from various streaming services and the like, demand deposit activity from consumer checking accounts, if provided on a consumer permission basis. All of that information has important signal that can help the reporting agencies provide an accurate, objective, and even more comprehensive picture of millions and millions more American adults.
How many, I know the Federal Reserve in New York in a 2018 study, which may be a little dated now, found that just over 10% of the adult population, about 26.5 million Americans, are not in the formal credit system. Are we making progress there? And you've talked a little bit about some of the alternative data sources you're trying to bring into the system.
Sure.
Do you think policymakers have an appreciation of how this data or alternative data could expand financial inclusion?
Yeah, look, I think that some policymakers have a very good understanding of that and have advanced legislation that would um, enable greater access to that information at scale, right? And so we need more comprehensive measures that only can really be established at the federal level. But I think it's important that all policymakers realize that if we had this information and we could extend our ability to score the consumer population, it's going to allow more individuals to participate or to benefit from mainstream lending as opposed to alternative sources or going without. And that itself can drive access to capital and growth in the economy. And this goal of promoting financial inclusion, it's one of the few things that um, business and government uh, can collaborate and agree on in order to advance consumer interests in the U.S. And so I feel like there is an intersection of aspirations, of desires here by both parties, and we're in the middle of that, and would love to partner and help advance these legislative efforts, because it's a great way to both strengthen the economy, but allow fuller and fairer participation in the modern credit system.
So, in addition to bringing more data in the system, the financial services community is finding new ways to innovate, to find ways to serve those customers, including buy now, pay later, and other models.
Sure.
What does TransUnion do to try to bring some of that data into the system? And do you think financial innovation like buy now, pay later can be another way of accelerating the move up the ladder and adding rungs to the financial inclusion ladder?
Yeah, look, absolutely. I mean, the entire fintech revolution has helped bring access to credit to millions of consumers through real-time decisioning and easy user interfaces and the like, and still done it in a financially responsible and risk-adjusted way. BNPL is kind of the latest innovation in this domain, and it's been successful. It's rapidly growing, and it allows consumers really of all stripes, even those that currently have credit cards and access to mainstream credit information, or rather credit access. It gives them an alternative and convenient way to pay for things, right? By breaking it up into small installment payments. And so, the credit reporting industry has been partnering with those players so that they could begin reporting consumers' repayment behavior on all of those BNPL transactions, so that they could become part of their credit record. And so again, it's a vehicle through which a consumer, whether they be from a traditionally underserved or disadvantaged population, or let's say it's a young consumer, to make a purchase, to break it up into smaller, more manageable payments, to fulfill that obligation, and then have that show up on the credit record and help establish themselves where perhaps they can then apply and gain access to other types of credit. And so we're working currently with the industry to develop kind of the best and most efficient way for reporting that information, so it becomes part of the official credit record.
So you mentioned legislation, and I wonder, what do you think policymakers could do to really enhance the system? What do you need from policymakers to really make it easier to move faster on adding alternative data sources and creating credit files for more consumers?
Yeah, look, it's a great question, and there are clear options for policymakers, almost all of whom support the policy goal of broadening financial inclusion, right? And the two most effective levers to pull would be, one, to require the reporting of rental payments by all landlords, and corporate landlords above a certain level, so that all of those renting consumers get the benefit of their consistent payments or their payment history, regardless, on the credit record. And I would also extend that into the utilities and telecommunication services domain, because Those two categories represent a big part of every adult consumer's budget. And the majority of consumers are successfully serving those financial obligations. And just that act is powerful information for helping those consumers gain access to credit on appropriate risk-based terms.
Well, Chris, we really appreciate the leadership you personally brought that TransUnion are providing for the entire economy in trying to make sure that a system that works, that is the envy of the world in many ways. Many countries are trying to build some systems similar to ours and use data, that we continue to make it better and more accessible to all, and look forward to continuing to work with you as we advance that agenda. Thank you for joining us today.
It's my pleasure, David. Thank you.
Good morning. My name is Bill Hulse. I'm the Vice President of the Center for Capital Markets Competitiveness at the U.S. Chamber of Commerce. During our last session, we talked about bringing more data into the financial system. We're going to spend the rest of our conversation this morning talking about how financial institutions are making use of this data and other data to reach more consumers and to better serve their customers. I'm joined by Raghu Kulkarni, who's Vice President of Data Science at Discover Financial Services, Samuel Asefa, who's Head of AI and Machine Learning at US Bank, and Brian Stuckey, who's Team Lead of Ethical AI at Rock Central. Appreciate you joining this morning. So we have a lot of ground we want to cover, and so I think we can just jump right into it. Raghu, first question's for you. There's a lot of hype around artificial intelligence and machine learning. This is likely because the technology shows great promise. Given this technology and its applications are evolving, how would you define artificial intelligence? What do we mean when we say artificial intelligence?
Hi, Bill, and thank you for asking that question. And hello, everyone. Good morning. That's an important question, and in the underwriting criterion, actually, we use machine learning algorithms, and before we define the realm of AI, I would like to take a minute or two to showcase that there are core risk principles which are already built into the development process. So what do we mean by that? When we develop models in underwriting realm, we develop these models which are static and supervised, meaning we use historical data. These models don't change on the fly, and these are supervised, meaning we know the target behind what we are modeling for. We also have strict adherence to SR 11.7 guidelines provided by Federal Reserve Board. We also go through legal and compliance to make sure that we follow the ECOA guidelines. Apart from this, model risk management and internal audit have thorough and rigorous validations of these models as we develop them to look at our conceptual soundness, to ensure that the way we have built them makes sense. Apart from this, there is continuous monitoring of these models also. So what is the promise behind all of this if most of the process has remained the same? Well, these new age algorithms hold the promise of being potentially more accurate because they can take in more data variations compared to traditional approaches such as logistic. The newer versions such as gradient boosting algorithms and other bagging algorithms have the potential to be more accurate. That said, though, when we develop these models, we follow strict adherence to all the guidelines which have been provided so far around SR 11.7. In short, it's really rigorous, and the focus is always has been and continues to be on the transparency of these models, while bringing up the potential of them being more accurate.
Great. Thanks, Raghu. So, I do want to take a moment to move this from kind of a conceptual conversation about AI to really just a better appreciation for how each of your companies are using this technology. Briefly, can you each provide an example of how you're using AI to reach more consumers or to otherwise improve the consumer experience? Brian, I'm going to start off with you.
Sure. Thanks, Bill. And good morning, everybody. Happy to be here today. At Rocket Mortgage and across the Rocket companies, there is a lot of work that I would put in the general category of artificial intelligence. Some things that I think kind of get forgotten a little bit because they're not quite as cool as some of the other stuff, but doing intelligent OCR to be able to scan loan documents like W-2s and handle those very efficiently. Chatbots in a variety of areas of the company to enhance and make the client experience more efficient. Rule-based engines that really came from expert systems in the early days are prevalent at, I would guess, every lender that's out there right now, and they are at Rocket. But I think most interesting for our conversation here today is the work that's around machine learning, and certainly applying machine learning in all areas of marketing is something we have focused on very heavily, to the point of doing probably 8.5 million decisions every day that help us really tailor a client experience and help us reach potential clients at the right time of their life. And know what we think they're going to need and then how we can best provide that to them. We have enough data out there now. We have enough computing power that we can do that very reasonably and very, very effectively.
Thanks, Brian. And Samuel, do you want to share a little bit about how US Bank is using AI and ML?
Sure. Thank you. Thanks for having me. So at US Bank, we're also using AI in a number of use cases across the customer's journey, all with the goal of ensuring a safe and frictionless customer experience. Some of the examples mentioned earlier, for us, including fraud detection, anti-money laundering detection, personalization, virtual assistants, voice assistants. All of these are really, heavy AI machine learning users and deployed across the enterprise. We're also using data and AI to help customers become financially aware and independent through services that integrate advice on saving, investing, as well as help customers setting and achieving financial goals. And we have some products released, for example, Pay Yourself First, with Goals Experience. It's really good examples. In addition, we're using data and analytics to ensure a number of initiatives that are focused on expanding financial inclusion are effective. For example, our Access Commitment Initiative, which is focused on increasing access to mentorship opportunities, capital, to various members of our community. So we're working on using AI and machine learning and data to make sure we're understanding the needs and serving the customers well.
And Raghu, I'm going to bring it back to you quickly. You started off our conversation with just the importance of ensuring that we have rigorous, governance around the models that we're using for AI and that you're adhering to appropriate regulation. So when you're building these models, what do you have in mind for consumers, and what are the ways, some of the ways to discover is really taking advantage of this technology?
Yeah, and again, the focus has always been and continues to be on transparency. And when we extend the idea of machine learning algorithm usage to, let's say, explainability, the way to define it is really the ability to present these outcomes of these machine learning models in a more understandable and interpretable terms. And not just keeping them transparent, but also making sure that the outcomes are stable. So again, as we develop these models with the promise of being more accurate, the focus has always been on the causation as to why we are observing what we are observing, and then being able to communicate, document, and also being able to replicate as much as possible. That's really been the focus. And when we again talk more about explainability of these algorithms, the research has really proliferated in the financial sector. And there are two broad families of explainability approaches. One is you either build a more grounds-up interpretable model, or you use what we are colloquially called surrogate models or post-hoc explanations to explain these models. But no matter what approach you take, the fundamentals remain the same, wherein we want to ensure that we understand at each step what is happening, what is causing the decision, and what data attributes are really the key for the prediction.
Thanks. So I think this concept of explainability is very important. I know something each of your institutions is focused on, and helps get to this concept, or that AI is somehow a black box, or that what happens inside this black box is there's inputs going in, outputs, and there's outputs coming out, but we don't know how we get to that decision point, and that's not the case. Samuel, can you talk a little bit about the steps that you take at US Bank when you're putting together models to ensure that they are explainable? And then Brian, if you can just jump in and talk a little bit about why explainability matters depending on your audience.
Sure, certainly. So I think I agree with Raghu that the notion of a black box model in financial services really could not be further from the truth. For us, explainable AI, i.e. how the algorithm arrives at certain decision, it needs to be integrated with other important factors and aspects such as transparency, accountability, and the broader AI governance framework in order to be effective. And this is particularly important in the context of financial inclusion, because the question we ask, and most of us sure have this experience, is how do we ensure the outcomes of this model is clearly communicated, such that the consumer understands the decisions and they know what steps to take to improve the outcomes. So I think, like mentioned by the fellow panelists, we have steps that are extremely rigorous in terms of ensuring that we follow the procedures, but also making sure every step of the way there is a clear reason for building this model, as well as the outcomes are transparent. And in fact, this makes efforts, they take longer compared to other industries, and this frustrates some of our colleagues coming from other industries. However, we will ensure that we're doing the right thing and putting customers, their data safety first.
Yeah, and I'll follow up to that. I think Raghu did a great job of mentioning some of the technical approaches that one can take for explainability. And our challenge has really been trying to make those actionable and determine the best approach for the right situation, and more importantly, for the right audience. We've been saying for a while, explainability is in the eye of the beholder. I don't believe there's a one size fits all. Certainly the information I would take about a machine learning model to present to our leadership, or to a regulator, or to a client is likely going to be very different in every case. And we've got a lot of techniques that we can use to get to where we need to get for each of those. Again, with that no one size fits all, it really helps to figure out what our goals are going to be. I think Samuel just mentioned the notion of regulators making sure that we can provide a consumer all the information that they need to have. If we send them an adverse action notice and we say, we're sorry, we're unable to extend you credit, we can't just go and say, well, the reason was our machine said no. We've got to be able to explain why and take that apart. And I think the other key to this that we're seeing lately is an increased emphasis on much more underlying documentation about the model itself, why it's being built, the business value, the objectives, why have you taken this approach, before we even get to how we did it and take it apart there. That whole package, I think, is how we can start to piece together the right explanation for the right audience.
Thanks, Brian. Raghu, you'd mentioned that one of the risks that has been identified with AI is the potential for bias. And there seems to be a misguided belief from some that AI could inherently have more bias than other decision-making processes, including those decisions made by just an individual human. Discover Financial Services, working with HTO and BLDS, released a paper a couple of years ago exploring some of these concepts, which I've already touched on a little bit. What steps do you take to review the data that's going into these models to prevent bias? What are some of the controls that you have in place as a best practice?
Yes, and before I delve into answering this, I'd like to again reiterate what Brian and Sammy had mentioned about this hype and black boxiness. It again goes back to understanding what these algorithms are doing and ensuring at each step of the way how data is being used. And also to make sure that when you get an outcome from these models, make sure that there is an aspect of algorithmic bias versus what the data is getting us, right? So ensuring to understand what is inherent in the data and how the algorithm utilizes that data is the key. And some of the ways we do it is, I think I briefly mentioned this earlier also, is within the model development process, we have strong compliance presence, and we ensure that we only, again, use FCRA compliant data. We ensure that we do analysis, based on the guidelines from our compliance teams to make sure some of these proxies or other bias developing attributes may or should not be included, right? All those checks and balances have remained same and stronger from how we have been developing models in the past. So long story short, the process, the rigor has not changed. The approach or the algorithms which are being used to develop these models has changed. That said, the transparency in the documentation has actually increased while we develop all of this. So I hope that gives a glimpse into all the work which goes into utilizing these models.
Great. And Samuel, just one last question on this. We've talked a lot about the importance of model risk management and, much of the work that US Bank and Discover and Rocket are doing in this space. But you did mention that there's more frustration when some technologists come to US Bank and other parts of the financial services industry just because it's so regulated. Could you talk a little bit about how you consider SR 11.7 from the federal banking regulators as part of your just everyday work?
Certainly, yeah. So I think it has been mentioned. I think you will notice the similarities between financial service industries across the firm and the development process. So at US Bank, like Raigo mentioned and Brian mentioned, AI development is very much a firm-wide effort. It involves a review from a number of teams across the enterprise, including first, second line of risk, model governance, legal compliance, fair lending teams, you name it. Right? We have a great partnership with that. And that's in addition to the already existing rigorous review by the AI machine learning teams. So this will ensure that the models are, explainable, unbiased, fair, and more importantly, in accordance with the guidelines from the regulators. So for us, one way we're ensuring that this is happening in a principled way is by building on the already existing strong ethical culture at US Bank to establish a responsible AI program, which outlines a set of core principles, which is the easier part, because no one will disagree that models have to be, explainable, or we have to be unbiased. But the next layer down is how do we aim and how do we work towards adhering to those principles and mitigating bias in the data, the processes, the modeling are key aspects of our efforts. So, we have a really strong partnership with the regulators, the OCC, regular meetings with them to make sure we understand. We have AI governance meetings that run very regularly across the enterprise to make sure everyone, all the stakeholders are aligned on the requirements and we adhere to them as well.
Great. So I want to take this conversation back to what we just heard from Chris Cartwright, CEO of TransUnion. How important is data, both in terms of volume and quality, for achieving the promise of artificial intelligence? how can alternative data and AI be used to reach more consumers and to expand financial inclusion? Brian, kick this over to you.
Sure. I mean, data is just absolutely the key to all of this. And this is what can make it happen for what we are doing and what I think we can do moving forward. Because I'm glad during the introductions we didn't discuss how long ago it was that we were all studying. But when I first studied AI, machine learning, as we are typically doing it today, was not really a primary focus. And that was for two reasons. We didn't have the computing power, and we certainly didn't have the vast amounts of data that are available to us. Having those now, these techniques for machine learning are quite effective, and that's why I think we've seen their uses just spread like wildfire. So the data is the key, but like anything else, like any other computer system, data quality is critically important. You put garbage in, you're going to get garbage out. And having data governance in place, having your infrastructure built for it has got to be done first. And that really enables you to take advantage of the vast amounts of data out there. And by taking advantage of it, that lets us go, and we jokingly always refer to this as using AI for good. We look at our job with our ethical AI team right now as ensuring equality. But where we want to get to is to strive for equity. Can we find ways to reach underserved areas? Can we find ways to reach consumers that are good credit risks but won't qualify under traditional underwriting means? And that answer lies in the data. I think we can learn a lot from places where we find issues. If we are analyzing a particular geographic area and see an imbalance across demographics, that might start to give us some clues as to why, and more importantly, how we can reach them. Is it a history of rent payments, of utility payments, of paying your Netflix account? We've got endless possibilities here. Years ago, I heard IBM talk about Watson, that when they analyzed lending had found that Uber drivers were a good credit risk because they simply drove more when money got tight. Insights like that are going to be all around us. And that's when we're really going to make tremendous inroads on this idea of equity. But the data house has to be under control before that happens. And with that much data out there, there are risks to it, but treading carefully there, treading wisely, I think can overcome those so we can really do some incredible things.
Thanks. And building on that, Raghu, in July 2020, policymakers at the CFB issued a blog post noting AI may have a profound impact in credit underwriting, and they referenced Credit Invisible's report that they had done a few years before that, noting that AI has the potential to expand credit access. Can you talk a little bit how Discover has partnered with the CFPB through tech sprints and maybe other parts of the government to expand financial inclusion?
Yes, we did participate in the tech sprint organized by CFPB. The focus within those forums where government organizations are helping us showcase the way we develop our algorithms has been, again, to explain how the model has been developed and how we can do the explainability of the outcome of these models. And when it comes to utilizing new data and new algorithms, the focus has been, okay, we develop all these ML-based algorithm models, but what is contributing to these models to be more accurate? And lo and behold, it's really the core risk, credit risk principles or credit risk data, which has always been the key, the FCRA compliant data. So the way we have approached it is ensuring that we document all our approaches. We have written papers to ensure that they're peer reviewed, not just we saying some things, and also. Again, I keep repeating that word, okay, making it transparent at each step of the way to showcase the value these newer algorithms can bring on top of the computational power, which Brian mentioned, has been the real key for us to utilizing ML.
Great. Well, I want to thank all of our panelists for sharing their insight this morning. I think this conversation is an important step towards demystifying artificial intelligence and financial services. And for those of you who are broadly interested in artificial intelligence, I would encourage you to visit the website of the Chamber's Technology Engagement Center, CTEC. They recently launched a bipartisan AI commission on competition, inclusion, and innovation that's looking at these issues through a much broader lens. As we've learned in our conversation this morning, AI can only be successful as the data that businesses have available to input into their models. As the Chamber's report on risk-based pricing finds that we need more data, not less, to expand financial inclusion. Through data, there are new opportunities for reaching more consumers and bringing them into the regulated financial system. At the Chamber, we'll continue to partner with our member companies, Congress, and the executive branch to understand how we can bring more data to achieve our shared policy objectives. Thank you all for joining this morning.
Thank you.